Hello, welcome to my YouTube channel, and today's our video on IAS 16, which is related to the property, plant and equipment. We will discuss everything there, and here's our today's video's objective. We will understand the IAS 16, its definition and other its logics, and we will solve the practical problem there. I have an Excel file. We will solve this problem, and then I will show you how to record them. Okay, how to record them, how to find the values. I have this problem there and I have written down there, as well as I will pass the journal entries of all of these required, whatever we will calculate in our later stage of our video. So I will show you how to deal with the disposals as well when we are selling or getting rid of them. When we are selling or getting what will happen on the gain or disposals. How to handle the revaluations if their value changes, the transfer of any remaining revaluation surplus to retained earnings, etc. And everything we will cover in this video. So stay with me and I will show you what is IAS 16 actually is. And after this video, your concept related to IAS 16 will be covered, inshallah. So let's go to our first, which is understanding IAS 16. I am going to my PowerPoint slide there. Yes. IAS 16 is an accounting standard that tells companies how to account for property, plant, and equipment. Tangible items held for use in production, supply of goods, services, or for administrative purposes. Expected to be used for more than one period long term. What is IAS 16 actually is? These are the non-current assets, you can say. So these are not for 1 month, 2 months. These are for, this apply on the assets which have the long term of period. I mean to say 3 years, 4 years, 5 years somehow. So it's the big stuff a company owns and uses to make money, like machines, buildings, vehicles, etc. So IAS 16 is about keeping track of the things a company owns for long-term use and showing their cost fairly in the books over the time. So now we quickly go to our Excel file and I will show you step by step what we will calculate each and everything. Before it, we will understand our problem first. Let's go to the problem. IAS 16 property, plant and equipment is Bright Tech Limited purchased a new production machine on 1st of January 2021 and it's for $100,000 and the additional information of that machinery is also given. So we are taking one machinery's example. Okay, so the delivery and installation cost is $5,000 US. So this 5,000 for delivery and installation cost, 2,000 for testing and setup cost. So delivery and installation cost 5,000 mean to say, let's suppose the machine was in Los Angeles. Let's make it in our subcontinent. The machine was in Lahore and the machine was taken down to the another province, and the delivery of that machine, when we have the trucks, etc., anything, there are so much cost of there, and that was $5,000. And the testing and setup cost, when we test that particular machine, and we also spend $2,000 there. So the trade discount was minus 2,000, mean to say the trade discount we get from the supplier of the machine. They were giving us trade discount, so we minus the 2,000. And let's find out our next thing, which is estimated useful life is 5 years. Residual value is 5,000, means scrap value. After that some period of time, we estimate that 5,000 we will get after the selling of that machinery, and the depreciation method in straight line. So we are required to calculate annual depreciation, show the depreciation schedule for 2021 to 2023. We are going to showing this, and find the carrying amount at 31st of December 2023. On 1st of January 2024, the company decides to apply the revaluation model as well, and an independent valuer estimates the fair value 120,000. Mean to say, an independent valuer comes here and he estimates the value of that machine is $120,000. So the useful life is unchanged and the residual value remains 5,000. So we are required to compute the revaluation surplus and the new annual depreciation from 2024 onwards. Mean to say, we are going to the surplus. I will explain it later. And record the journal entry for revaluation. And on the last day of our 2025, the company sells the machine for 80,000 now. And we are required to compute the accumulated depreciation to the date of sale. Keep in mind this, to the date of sale. So carrying amount at disposal and gain or loss on disposal. Disposal is actually mean to sell anything or to get rid of that kind of an asset. And the general entry for the disposal. Transfer any remaining revaluation surplus to retained earnings. So now we will calculate step by step. And first of all, we have to find out the total initial cost of that particular machine. So we have the initial cost. Let's find out the initial cost, which was 1 lakh plus our delivery and installation cost, and then plus we have the trading discount, and then plus our trade discount. Okay, when we click the enter, so we have 1,50,000 of the initial cost of that machine, and the residual value, we have that value. Where is this? Here's our residual value, mean to say scrap value, and the depreciable amount would be our initial cost and minus our residual value. So 1 lakh is our depreciable amount. Then the annual depreciation would be, mean to say, annual depreciation, we will count on the 1 lakh amount, which is mean to say we will calculate our in straight line method. We have the cost minus residual value. So the depreciable amount is 1 lakh and divided by life. So before this, we are going to pass a journal entry first before counting any depreciation. I will advise you to pass the journal entries before any kind of. So let's pass the journal entry of this, of the capitalized cost. So the 1st of January, okay, 1st of January, let's add the column little bit here and write down there date and first 2021. Yes. Yes. No. So this, which account would be debit? You know what? We purchase the machine. So it means to say the asset is increasing. So we will debit the property account, or we can say plant and equipment, and write down there machine. Okay, and debit the amount. Debit how much? It's 1,05,000. Then what will be credit? So make it a little bit to cash maybe, and this was not disclosed. It was the cash or it was the payable, whatever it would be. So I'm assuming it the cash or payable. So our credit is 1,05,000 rupees. So this is our first journal entry which we have passed. We can write the narration there. Machinery being purchased. Okay, here, and make it right now. So we have a machinery being purchased. We have added the journal entry. Now we will calculate the annual depreciation. So it's very straightforward. Cost minus residual. It means we have the depreciable amount there, which is I5 divided by our residual, our total life, which is 5 years. So our annual depreciation would be 20,000, and the total depreciation for 2021 to 20 2023. We will now calculate it. So for calculating the complete depreciation of table, we will have to add the depreciation of first year. It's the straight line method. I can write there. We can write the straight line method. Okay, so our depreciation is what was our depreciation? It was 20,000. It was 20,000. So 20,000 was our depreciation, and the accumulated depreciation would be 20,000 also. Accumulated depreciation. Make it counting as well. And here. Yes. And the net book value would be here initial cost minus our depreciation. So this is our first year's depreciation, and for the next year we will calculate the depreciation as same like that. I'm making this and adding the $sign, and the accumulated depreciation would be this plus this. Okay, and for the net book value would be this minus and this. Okay, we are for the net book value is actually the initial cost. Okay, so keep in mind this. And again, just drag and drop there 20,000, and this is also 60,000 it will be, and this would be the 45,000. So this is our net book value for the year 2023. Then our next part would be started. So we have calculate the depreciation. We have calculated the depreciation. We have shown the depreciation schedule as well, and we have find the carrying amount at 31st of December 2023, which is 45,000. Okay, hopefully you have understood this. So we have find out this. Now we have what to do. Don't go to the part D. We have to pass the journal entry as well for the depreciation. And for annual depreciation, we have to find the add the journal entry. So we are going there, and now we are passing our journal entry again. And what we will do is we will depreciate the expenses of recent year. Depreciation expenses will be debited and 20,000, and to accumulated depreciation, which is 20,000 of recent year. So this is just because we have to being the. So this is just because our depreciation would be counted for the recent year, which is 2021. So now the step 3 will come. We have passed the journal entries, and now the step 3 has been done. On 1st of January 2024, the company decides to revalue the machine. An independent valuer estimates the fair value at 120. So the carrying amount before the revaluation, what was that amount? It is 45,000. Okay, so 45,000 was our carrying amount before this. An independent valuer estimates the fair value of 120,000. So we will write down there the 120,000. So what will happen? So on 1st of January we have calculated the gain, and the net book value was 120,000, fair value was 120,000 and the carrying amount was 45,000. So how much we have actually, if I would say minus the carrying amount, I have 75,000 of gain. Gain is 75,000. So this gain would go to, where it would go? This surplus goes to the equity section. Okay, it will go to equity section. It's not in profit and loss account. So it will not go to the profit and loss account. It will directly go to the equity section, and it is actually the revaluation surplus of 75,000 in equity. Okay, so now what will we do? We'll again accumulate depreciation past the journal entry as well. So let's add the again journal entry. So what will be the journal entry? It will debit. What would be debit? It will accumulated depreciation will be debited. Accumulated depreciation would be debited, and it is you can say it was 60,000. Yes, and to where it would be go? What would be credit? Credit the property, or we can say property, plant and equipment. You can say the machinery, our machinery, which was our machinery. Okay, so it was also 60,000, and you can narrate them that the accumulated depreciation was adding. Okay, now we will record the valuation of the fair value as well, and before this we just depreciate the revaluation, mean to say, and before this we have to, so before this record the revaluation to the fair value as well, which was 75,000, sorry. Now the next journal entry would be debit the property. Again, I'm just copying this, and you can see we will debit the property machine, and then we will debit the amount. How much? It is 75,000. We can see there, and then we will credit the revaluation surplus, which is 30. So we'll predict the 75,000 as well, sorry, 75,000 as well, and we can rate that the machine is recorded at, actually it is the machine is recorded at 120. You know that 120, and the accumulated depreciation is 0. So remaining useful life is how much? It's 2 years are remaining, because our, you can see there, our estimated useful life was 5 years from 2021 to, it would be December 31st 2026. And for this we have already added the for year 2024, and 24 will be remaining. So December 31st 2025 till we have the 5 years, and we have to find the depreciation after the revaluation. So let's find it. Our step 4, which is the depreciation after the revaluation. Okay, now our let's amount depreciation to the date of sale. So let's find out the depreciation amount for this. It was how much now? The depreciation amount, it's 120,000, 1,20,000. It's our new net book value, you can say. Okay, so revalue amount, our this, and minus our residual value, which was scrap value. So it will remain same. Our scrap value will remain same, and divided by and then divided by our how much life is 5 years? No, it's 2 years now. So we have the depreciation of 57,500 is our depreciation, and the net book value now, and the net book value is actually 120 and minus depreciation. So this is our net book value, which is 62,500. So again, the depreciation, which is obviously the straight line method, and depreciation is let's find out there. It's our add the dollar sign, and this is also, and the net book value would be, again it has been here, we have to add this. So 5,000 would be our net book value now. So this is our net book. We have find the net book value and the depreciation for the after the revaluation. What we do, will now add the journal entry again. Adding the journal entry, we will depreciation expense again. How much? It's 57,500 and 2 accumulated depreciation 57,500. Now step 5, it's our carrying amount at disposal. So our carrying amount is actually, this is our carrying amount at the disposal, and gain on disposal or on loss on disposal. So what was our sale proceeds? Okay, sale proceed, I can say this time the company sells the machine for 80,000. So our 80,000 was our sales proceeds and minus our, you can say, carrying amount, which was 5,000. So we had 75,000 of gain, we can say gain. So this is our gain again, and we will record it into the journal entry again. Let's add that cash, or we can say bank. It was not disclosed how much we gain. It's about 80. Before it, let's add the rupees first. We rupees or dollar first. We get the 80,000 from the customer. So let's add, we will make it double 80,000 and then debit the accumulated depreciation for the year. How much it was? It was 1,15,000 rupees. How it's 1,50,000 rupees? It's actually it's actually the 2 years, like 57,000 and 57,000. So the both of them make it accumulated depreciation, which is 1,15,000. It's a very simple, straightforward numbers. Then now I am crediting the first one is the property, our property, plant and equipment, our machinery account. How much it was? It was 1,20,000 was its fair value. Okay, fair value was 1,20,000. We are crediting this, and again we are to gain on disposal, you can say. You know what, this will go to the direct P&L account. Okay, this will be go to P&L account. How much it is? It is, we gain the $75,000. Again another journal entry would be recorded, which is revaluation surplus. We will revalue the surplus of retained earning. This is our transfer and remaining revaluation surplus to the retained earning. So we'll add the again journal entry revaluation surplus, and you can say equity, which is 75,000, which we have discussed there, 75,000, and 2 where it will be go to retained earnings. Retained earnings, which are 75,000. Wait, 75,000 US dollars. So here's our recap of IAS 16. With this example, we have purchase and capitalization of including all the attributed cost. Here we will make this, and the depreciation spread the cost over useful life. We will spread the depreciation. It is actually very a simple logic. It is only simple mathematics plus addition, but you have to understand the logic first. Okay. So when we reevaluate the assets value, it's increase the asset to fair value. We record surplus in always equity, and the depreciation after the revaluation we compute on the revalued amount over the remaining life, and the disposal is we record the gain and loss and transfer any revaluation surplus to the retained earnings. Hopefully you have enjoyed my video, and if you find any kind of hopefully you have understood my point, and have a good day and bye.